class, we will focus on the role of inventories within the income statement. Inventories of raw material, work in progress or finished products are really important because we can find them either in the balance sheet but also in the income statement. So what's the difference? If we have inventories within the balance sheet, we can identify within the current asset of the balance sheet the value of inventories at the end of the period, because the balance sheet provides a snapshot of the company in a precise moment of time. So if we look at the inventories within the balance sheet, we find the value of the inventories at the end of the period. But we have also inventories within the income statement, but in this case we don't have the overall value of the inventories that we have in the warehouse, but in this case we have the difference, the variation in the value of the inventories between the beginning of the year and the end of the year. Let's try to understand more in detail what does this mean, and so how we can recognize the variation of the inventories within the income statement. We need to think of the initial part of the income statement itself. So if you remember, we have in the income statement the revenues minus the cost of sales. This is the income statement by function, but the same happens if you have the income statement by nature. So the revenues minus the cost of sales gives rise to what is defined as gross profit. So the revenues and the cost of sales are recognized by using an actual logic. So we have that revenues are the revenues which are related to the selling of the product or rendering of services within the specific year, while the cost of sales represent the value of resources that are used and absorbed for production for that specific year. Let's try to understand what this cost of sales means. Assuming that we can represent our production process, so this is the production process as a black box. So we have that at the end of the period we have the finished product. So for example, at the end of the year we have some finished products that are sold. The revenues which are associated to the selling of this finished product enter here. But of course, in order to realize this finished product, the company absorbs some resources. So we have as input the purchases of, for example, raw material, the purchases of all of the resources, so raw material, components, labors, and so on. These purchases enter as resources within the production process. But of course, at the beginning of the period, we don't have only purchases, but we might have also some inventories. So we can have what is defined as inventories at the beginning of the period. For example, assuming that at the beginning of the year, the company decides to purchase raw material, and the value of these purchases of raw material is equal to 1,000 euros. But then we have that at the beginning of the period we have some beginning inventories, and we have that the value of these inventories at the beginning of the year is like 300 euros. So basically the purchases plus the inventories at the beginning of the period represent what is available for the company for production. So these are the resources available, which are not the resources that are absorbed. So we need to consider, adopting the actual logic, everything that is absorbed for production. This means that we need also to consider the fact that at the end of the period, the company will realize, of course, finished product, but we might have at the end of the period also inventories, which in this case are inventories final. So if we go back to our example, assuming that we have at the end of the period inventories at the end of the year which are of 500 euros, we will have that the available resources are 1,300 minus the inventories that we have at the end of the period, and we will have that the cost of sales, which is basically the amount of resources that have been absorbed for production within the specific financial year, is equal to 800 euros. So if we want to generalize, we can say that the cost of sales, which as I said is defined by adopting an actual logic, equals the amount of purchases by the company plus the inventories at the beginning of the period, where this amount represents what is available for the company for production, minus the inventories at the end of the period, so that we have considered the overall amount of resources absorbed in the financial year, which is the cost of sales defined by adopting an actual logic. So that's the role of the inventories within the income statement. So we take into account their delta, their variation, not the overall value. And this is true for the finished product, work in progress, and raw materials. If we have the income statement by function, all of the type of inventories are included within this cost of sales. It is different if we have the income statement by nature, because we will have that the variation of the inventories final enters the amount of the revenues, while the inventories of raw material enters the cost of sales.